Hello everyone, welcome to Rajeshwari's Commerce and Management Study Hub. I am Rajeshwari here. Let us continue today the ratio analysis, turnover ratio or activity ratio. Activity or turnover ratio. In the previous class, we have understood liquid ratio and solvency ratio. The activity or turnover ratio, it is also called as sales ratio, and this will be calculated by times. And here, higher the turnover ratio means it helps us to understand the better utilization of the assets and improved efficiency and profitability. Better utilization of assets and improved efficiency and profitability. When higher, the ratio is higher, that indicates the better utilization of assets and improved efficiency and profitability. Under this activity or turnover ratio, we have totally 6 categories of ratios. The first one is inventory turnover ratio, trade receivables, turnover, trade payable turnover, investment or net assets turnover, fixed asset turnover, and the last one is working capital turnover. See, these all the ratios, mainly the turnover ratio will help us to understand the revenue from sales. Okay. So we can also call these our sales ratios. The first ratio is inventory turnover ratio. Let us understand inventory turnover ratio. Inventory turnover ratio. This inventory turnover ratio helps us to understand how many times we can convert the inventory into finished good, then to generate revenue from the operations. And this also helps us to measure the liquidity also. The formula for inventory turnover ratio is cost of revenue from operations, divided by average inventory. So first we will understand how we are calculating the cost of revenue from operations. Cost of revenue from operations. RFO means revenue from operations. That is net sale. It is equal to net sale. How we are calculating net sale? Total sales minus sales return. Sales return. Or we can also calculate cost of revenue from operation by taking consideration opening inventory, that is opening stock, plus purchases plus direct expenses minus closing inventory, that is closing stock, closing inventory. So what do you mean by direct expenses here? The direct expenses are which are directly attributable, that when converting a raw material into finished product, the whatever the expenses you are incurring, no, those expenses are called the direct expenses. So here we have some of the examples for the direct expenses is inward, then wages, whatever the expenses they mentioned and given factory, wages, then purchases, related expenses, production or manufacturing related expenses. Manufacturing, production or manufacturing. Now let us understand by solving one question with an example. The question is, from the following information calculate inventory turnover ratio. So the information is inventory in the beginning 18,000, inventory at the end 22,000, net purchases 46,000, wages 14,000, revenue from operations 80,000, carriage inward 4,000. Now let us calculate what is the formula for inventory turnover ratio. Cost of revenue from operations divided by average inventory. So first we'll find out the cost of revenue from operations. So cost of revenue from operation, how we are finding? By taking into consideration the opening stock plus purchases plus direct expenses minus closing stock or inventory. Right? Now, the opening inventory is given. Here, revenue from operations is given. But we don't want this. We want cost of revenue from operations. Okay. So, opening stock is 18,000 plus purchases is net purchase is given after deducting the purchase return 46,000 plus direct expenses wages is given 14,000 minus closing stock is 22,000. So 18 plus 46 plus 14 is one more item we have carriage inward, that is also coming under direct expenses. So add 4,000 here. 18 plus 46 plus 14 plus 4,000. 18 plus 46 plus 14 plus 4 is 82,000. From this 82 minus 22,000, we'll get cost of revenue from operation is 60,000. Right? 60,000. Now average inventory. Average inventory, opening inventory plus closing inventory, closing inventory divided by 2. Average we are taking, okay. So opening inventory is 18,000 plus closing inventory is 22,000 divided by 2. 40,000. 18 plus 22 is 40,000 divided by 2. So average inventory is 20,000. 20,000. Now let us calculate inventory turnover ratio. Cost of revenue from operations is 60,000 divided by the average inventory is 20,000. So it is 3 times. Here always we are representing the ratio in times, 3 times. Okay. Now the next ratio is trade receivables turnover ratio. Trade receivable turnover ratio. Formula is net credit revenue from operation, that is credit sale. Net you are taking after deducting the sales return divided by average trade receivables. So how you are finding the average trade receivables? That is opening debtors and the bills receivable. Opening bills receivable plus closing debtor and closing bills receivable divided by 2. And this ratio helps us to understand the liquidity position based on the trade receivables are realized, and helps to understand the relationship between the credit sale and the trade receivables. Okay. Now let us understand with an example. Calculate trade receivable turnover ratio from the following information. Total revenue from operations is 4 lakh. Cash revenue from operation is 20% of total revenue from operation. So what does it mean? The total sales will be 100. Out of this 100, the 20% is the cash revenue. Cash revenue means cash sales. Cash sales. So here we want only the credit sale. While calculating trade receivables, we are considering only the credit sales. So the remaining is 80%. That 80% you are considering for the calculation purpose. Okay. Then trade receivables 1/4. 1/4 means beginning 40,000. Trade receivables as at 31st March means ending 1,20,000. Now let us calculate. What is the formula? First we'll write the formula. Trade receivables turnover ratio. Take pen and paper, solve the question with me, or take your textbook, try to solve with me. Then only you will be able to understand. So I will write net credit sales divided by average trade receivables. ನನ್ನ ಜೊತೆ ಪ್ರಾಕ್ಟೀಸ್ ಮಾಡಿದ್ರೆ ನಿಮಗೆ ಪರ್ಫೆಕ್ಟ್ ಆಗುತ್ತೆ. So and you will understand more. Okay. Now credit revenue is, credit sales is how much? Credit sales is from total revenue. Total revenue is 4 lakh. Out of 4 lakh, you need to minus or deduct 20% of cash sale, or you can directly calculate on 4 lakh 80% also. Now we'll try both. Okay. 4 lakh. What is the 20% of 4 lakh? 4 lakh into 20%. 80,000 minus 80,000. So the balance is 3,20,000. 3,20,000 or 4 lakh into 80%. 8 fours are 32. 3,20,000. Okay. So this is our credit sales. Now we need average debtors, right? Average trade receivables. How we are finding average trade receivables? Opening is 40,000. Closing is 1,20,000. Opening plus closing divided by 2. 1,20,000 plus 40. 1,20,000 plus 40,000. 1,60,000 divided by 2 is 80,000. 1,60,000 divided by 2 is 80,000. Average trade receivables is 80,000. Now we have the net credit sale, that is 3,20,000 divided by 80,000. Average trade receivables. So 3,20,000 divided by 80,000 is 4 times. 4 times. Now let us understand the trade payable turnover ratio. So here we are calculating the trade payable turnover ratio. Payable means you are paying to the supplier, means you have purchased the material. So here we are taking the credit purchase. When trade receivables we are considering credit sales. Credit sale ತಗೋತೀರಿ, ಇಲ್ಲಿ credit purchase ತಗೋಬೇಕು. Net credit purchase divided by average trade payable. So how we are finding average trade payable? Opening creditor and bills payable. Bills receivable in trade receivable, bills payable in trade payable. Okay, plus closing creditors and bills payable. Closing bills payable divided by 2. And average payment period also here we are calculating. Number of days, it can be calculated in the days or month, divided by trade payable turnover ratio. So this helps us to understand the average payment period and relationship between the credit purchase and trade payables. The lower the ratio indicates the longer period. You have taken longer duration to repay the amount. The delayed payment, it is not a good policy for the company, and it may affect on the reputation of the company also. Now let us understand this with an example. The question is, calculate the trade payable turnover ratio from the following figures. Credit purchase during the year is 12 lakh. Creditors, opening creditors 3 lakh. Bills payable opening 1 lakh. Creditors closing 1,30,000. Bills payable closing 70,000. So what is the formula for trade payable turnover ratio? Trade payable turnover ratio is equal to credit purchase, that is net credit purchase. Credit purchase divided by average trade payable. Average trade payable. Here directly the credit purchases are given, so there is no adjustment for credit purchase, but we need to find out now average trade payables. Average trade payable. So average trade payable, how we are calculating? There is opening creditors plus bills payable plus opening. Closing creditors, that is bills payable plus closing bills payable, whole divided by 2. What is your opening creditors? 3 lakh. Bills payable opening is 1 lakh. Creditors closing is 1,30,000. And bills payable is 70,000. Whole divided by 2. 4, 5, 6. Right? 6 lakh divided by 2. 3 lakh. 3 lakh is average trade payables. Average trade payable is 3 lakh. Okay. Now let us calculate trade payable turnover ratio. Total credit purchases 12 lakh divided by average trade payables is 3 lakh. 4 times. 4 times. Right. Now we have next ratio, that is working capital turnover ratio. Net asset or capital employed turnover ratio. So this ratio helps us to understand the relationship between the revenue from operations, that is sales, and the net asset, that capital employed. Higher the ratio indicates the better activity and profitability. The first ratio here we are calculating is net asset or capital employed turnover ratio. That is revenue from operations divided by capital employed. So capital employed we can calculate in a two form. That is, one is asset side or liability side. When we are calculating asset side, we are taking all non-current asset plus working capital, that is current asset minus current liability. In case we are taking a liability side, then shareholders fund plus non-current liability. Okay, so further we can calculate the capital turnover ratio. We can understand by using the fixed asset turnover ratio. So here net revenue from operations divided by net fixed asset after deducting the depreciations. Working capital turnover ratio, net revenue from operation divided by working capital. Fixed asset turnover ರೇಷಿಯೋದಲ್ಲಿ ನ್ಯೂಮರೇಟರ್ ಏನಿರುತ್ತೆ, ಸೇಮ್ ಇರುತ್ತೆ ವರ್ಕಿಂಗ್ ಕ್ಯಾಪಿಟಲ್ ಮತ್ತೆ ಫಿಕ್ಸ್ಡ್ ಅಸೆಟ್ ಅಲ್ಲಿ. ಓನ್ಲಿ ದ ಡಿನಾಮಿನೇಟರ್ ಚೇಂಜಸ್. ಸೊ ಇಲ್ಲಿ ಏನ್ ಕ್ಯಾಲ್ಕುಲೇಟ್ ಮಾಡ್ತಿದ್ದೀರಾ, ಫಿಕ್ಸ್ಡ್ ಅಸೆಟ್ ಟರ್ನ್ ಓವರ್. ಸೊ ಫಿಕ್ಸ್ಡ್ ಅಸೆಟ್ ವಿಲ್ ಬಿ ಅವರ್ ಬೇಸ್. ಅದಕ್ಕೆ ನಾವು ನೆಟ್ ಫಿಕ್ಸ್ಡ್ ಅಸೆಟ್ಸ್ ನ ಕನ್ಸಿಡರ್ ಮಾಡ್ತೀರಿ. ವರ್ಕಿಂಗ್ ಕ್ಯಾಪಿಟಲ್ ಅಲ್ಲಿ ವರ್ಕಿಂಗ್ ಕ್ಯಾಪಿಟಲ್ ಈಸ್ ಅವರ್ ಬೇಸ್. ಸೊ ವರ್ಕಿಂಗ್ ಕ್ಯಾಪಿಟಲ್ ನ ಕನ್ಸಿಡರ್ ಮಾಡ್ತೀರಿ. ವರ್ಕಿಂಗ್ ಕ್ಯಾಪಿಟಲ್ ವಿ ಆರ್ ಕ್ಯಾಲ್ಕುಲೇಟಿಂಗ್ ಬೈ ಟೇಕಿಂಗ್ ಅ ಟೋಟಲ್ ಕರೆಂಟ್ ಅಸೆಟ್ ಮೈನಸ್ ಕರೆಂಟ್ ಲಯಬಿಲಿಟಿ. ಸೊ ದಿಸ್ higher ratios indicates, higher turnover indicates efficient utilization of resources and the liquidity and profitability position. Okay, now let us understand all these three ratios with an example. The problem is, from the following information, calculate net asset turnover, fixed asset turnover, and working capital turnover ratio. The balance sheet is given and revenue from operations for the year is 30 lakh. Now let us calculate first net asset turnover ratio. Net assets turnover ratio. So what is the formula for net asset turnover ratio? Revenue from operations divided by capital employed. Revenue from operations divided by capital employed. Revenue from operations are given. So let us calculate the capital employed. Capital employed. So capital employed, here we'll calculate by using the liability side, or you can take net asset also. I'll show you both the methods. First we are taking liability side. Liability side. So when we are taking liability side, we are taking the shareholders fund. Shareholders fund plus non-current liability. Non-current liabilities. So here shareholders fund we have preference share capital and equity share capital. That is 4 lakh plus 6 lakh plus non-current liability. Reserve fund, general reserve also we are considering under shareholders fund. That is 1 lakh plus 3 lakh. Debentures or non-current liability 2 lakh. 14% loan 2 lakh. Credit note 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 2 lakh. C Creditors, bills payable, outstanding are the current liabilities. These we are not considering. Okay. So what is our total liability? 4 plus 6, 10, 11, 14, 15, 16, 17, 18 lakh. 18 lakh. Right. Now let us try this same thing for the asset side also. We are calculating capital employed by taking the asset side. So asset side we are taking non-current asset plus working capital. So which are all non-current assets? Plant and machinery 8 lakh plus land and building 5 lakh plus motor car 2 lakh, furniture 1 lakh. 1 lakh. Inventory, debtor, bank, cash we are taking under the current assets. Working capital, how we are calculating working capital? Let us calculate working capital. Current asset minus current liability. Current assets minus current liability. What is our total current asset? Current assets are inventory 1,80,000 plus debtors 1,10,000, bank 80,000, cash 30,000. Current asset. Total is 1,80,000 plus 1,10,000, 2,90,000, 80, 4 lakh. Right? 4 lakh. Now current liability is creditors 1,40,000, bills payable 50,000, outstanding expenses 10,000. So total 1,40,000, 1,90,000, 2 lakh. Right. Now working capital is current asset is 4 lakh, current liability 2 lakh. 4 lakh minus 2 lakh is 2 lakh. 2 lakh is working capital. So what was our total non-current asset? Non-current assets are 8 lakh plus 5, 13, 14, 15, 16. 16 lakh. 16 lakh. Now 16 plus 2 lakh. The total asset side capital employed is 18 lakh. See, when we are tried with the liability side or asset side, the answer will be same. 18 lakh, 18 lakh. Now we have capital employed and working capital also. Now let us calculate. The first one is net asset turnover ratio. Net asset turnover ratio is revenue from operation is given 30 lakh. 30 lakh divided by capital employed is 18 lakh. 18 lakh. 30 lakh divided by 18 lakh. 1.66 is there. 1.67 will consider times. The second one is fixed asset turnover ratio. Fixed asset turnover ratio, the formula is net revenue from operations divided by net fixed assets. So fixed asset turnover revenue from operation is 30 lakh divided by the net fixed asset is 16 lakh. 30 lakh divided by 16 lakh. 1.88 times. Right. The last one is working capital turnover ratio. Working capital turnover ratio, the numerator is same. Right. That is revenue from operations divided by working capital. Revenue from operation is 30 lakh divided by working capital is 2 lakh. 30 lakh divided by 2 lakh, 15 times it is. 15 times. I hope you all understood. Practice. Only practice makes you perfect. Okay, thank you for watching. If you are not yet subscribed, kindly subscribe the channel. Press bell icon to receive update. Have a great day.